Ansett Capital joining in. Anurag, finally some reprieve coming in for the global markets. I just wonder what this would potentially spell out in terms of the widely anticipated interest rate cut by the Federal Reserve later this month.
Yeah. One morning. Look, I heard the discussion and it's broadly on point. There is generally no risk to the economy. September, October generally are weaker months. I mean, just go 1 year back, there was also another 4 to 5% correction in September. So usually because many of the funds close their year in September, they sell the loss making stocks, and that creates a bit of a fall in the market. And never mind even the yen carry trade. My sense is it's also gradually unwinding, and some of the good analysis also is there in the market. So I think all said and done, that will continue. But I think we can look forward to about 3 rate cuts, about 25 basis point, one in each meeting for this year. I don't think there's any need for anything more than that. The economy is showing all the good signs. The unthinkable, impossible soft landing somehow has been achieved. So good news.
You're already saying, Anurag, that soft landing has been achieved, though I thought there's a long road to go there. But do you think, if at all, there is a 50 basis point cut, that will augur negative news for the markets, because that will show what kind of growth concerns Fed is kind of reckoning with?
Yeah, no, I don't think they'll do 50, and 50 will spell trouble, right? And you want to use a stronger hammer when it is needed. So I don't think currently the economy needs 50, and I think everybody broadly is kind of the same view. So I think as long as the jobs being created every month are still to the tune of 120, 130. I understand it's below 150, which is the normal rate, but it's not below 100K as well, right? So they don't need a 50. I think they want to keep that buffer in their pocket. So 25 is good enough directionally, and I think 25 every meeting, 3 meetings, that's good enough. Yeah, I don't think anybody wants. You don't want a 50 because of some bad news, right? Nobody wants that, at least in the markets.
So Anurag, a bit of a macro question here, which is that rates for the first time after COVID will come down now. And we were using this analogy of weather, the most unspoken impact on how you dress. And interest rate is the most obvious factor in which how you change the way how you approach investments. So if interest rates are likely to go down, which they will, we are debating whether it is 25, 50 or 75. That is the only debate. But directionally, we know interest rates are moving lower. If that is true, how does investor realign their portfolio? Go back to emerging markets, invest in bonds, move out of equities? What changes?
Yeah, correct. So, Nikunj, broadly, the advice in US is, if not 60-40, then 70-30, right? Because, one sense is that at 5,600, S&P is broadly at an entitlement level. So index-based ETF growth is unlikely to be seen. So I think a 70-30, 30 towards bonds, because as the rates move from 5.5 to say about 3.5 in next 2 years, there is about a 15 to 20% gain to be had in the bonds investing. So that's a good balanced portfolio out here, especially considering the risks as well. But 70% can stay in equity because, when the rates come down, the small caps and mid caps also give a solid rise. So it depends on the style, but I think 70-40, 70-30, you can't go wrong. Indian markets or emerging markets, it's all good news. 10-year yield is always very directly correlated to the money that flows into emerging markets. So I think it's all good news for emerging markets as well, right? More risk capital available, and more money will chase the highest returns. And I think India is one of those places. So money will go there as well. I think that broadly holds true for India as well, Nikunj. I think just as we are on this topic, especially in India, I think people can even go 60-40. I understand the rates can't drop too much below 7, but even if the 10-year yield goes from a 7 handle to a 6 handle or a 5.5, I think there's a good safe returns to be made in the bonds vis-a-vis the equity, right? So people can be a little more aggressive on bonds in India, especially, right? That's my sense.
Okay, so perhaps looking at bonds as a good investable opportunity. That's the latest coming in. Thanks, Anurag, for making time and stopping by. I always, appreciate your time.
If you like this video, then like, share and subscribe to ET Now.